Welcome back to my channel. So today we are going to discuss about 6 investing rules of Warren Buffett for getting the richest man in the world. So Warren Buffett, also known as the Oracle of Omaha, he is no stranger to the world of investing. So there are lots to learn from the most successful. And did we also mention the richest man in the world of investing? So there are 6 lessons from Warren Buffett that you can use to invest for better. So first rule is, if you buy things you don't need, you will soon sell things you need. So it means that you can make more money not only by investing or taking up a second job, but also by resisting the temptation to go out and just splurge. As the saying goes, a penny saved is a penny earned. So there are some takeaways also, like to be a successful investor you need to use due diligence. Spending wisely is not about being misery, but about being smart. Invest is assets that you give good returns over the long term, one that helps you secure your financial futures. And number second rule is, price is what you pay and value is what you get. So if I describe it, then most of us know this: the money we pay for something and the value we get out of it most of the time. So the does not have a correlations. You could possibly buy a posh apartment for 1 crore rupees, but staying in the apartment does not guarantee a high quality of life, does it? So when it comes to investing, especially the stock market, the price of a stock is mostly governed by market sentiments and not necessarily by the probability or value of the company itself. So Warren Buffett suggests that to buy stock when the price you have to pay for the stock is less than the instinct value of it. He says, whether we are talking about socks or stocks, I liking to buy quality merchandise when it is marked down. So also there is also key takeaways. So instead of trying of time to markets the an accident, every rupee profit you can possibly get out of your investment. Invest is assets that will generate inflation's beating long-term returns and hold on it for a long time, in Warren Buffett term, forever. So number three rule is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So it means there's Warren Buffett recommend investing in undervalued stock with great potential and holding on it to them forever, in line with this philosophy, which undoubtedly worked so well and still continue to work. But buying shares of one wonderful company at a fair price is much better than buying a mediocre company at a cheap bargain price. So Buffett notes that over the long term, medical companies gives much lesser returns compared to wonderful companies. So such that the bargains price for which you thought the Medicare company stocks does not seems like a bargain anymore. So there are some takeaways. This is like, don't try and time the market or buy into NFO. So mutual funds, because the NAV is low, invest whenever you have the money and hold it for as long as possible. So number 4 rule is, be loss averse. So majority of investors measures performance solely based on return, and Buffett advice is like that you should not strive to make every dollar a potential profit, which involves too much risk. Instead, you should be loss averse. Preserving your capability should be your top goal, but by avoiding loss, you will naturally be inclined toward investment with assured return. As Warren Buffett put it, rule 1, never lose money, rules 2, never forget rules 1. So there are some takeaways is like while Buffett talks about safety of capital, he is referring to stock investing where you don't become greedy and go after too good to be true stocks. Instead, you focus on stocks that you undervalue and are companies that you understand and as long as potential. So many investors misunderstand this as a recommendation for investing only in bank FD or equivalent asset, which are mostly considered safe investing in bank FD. Actually, bank FD is the most always granted to be a losing proposition over the long term, since after tax the returns you get annualized and below inflation rate. And now is number 5 rules. To number 5 rules is like a be tax savvy. So like all billionaires, Buffett too is tax savvy. He knowledgeable Be knowledgeable about tax law and use them to your advantage before you invest. Make sure you understand the tax implications of your investment. So, for example, like while investing in bank FD might give up 9% return, the interest is actually taxable as per your tax bracket. So the real returns, if you are in the 30% tax bracket, will fall to just a little above 6%. So now that's below inflation's rate and you are effectively losing money the longer you invest in it. The takeaway is understand the tax applications of your investment fully before making a choice. So this is the number last and not the least. Limit your what you borrow. So more is not always good. Case in this point. Loans and credit are card debt. So with the daily offers from e-commerce companies, it might be tempting to buy that largest mobile phone on an EMI, considering the fact that the phone you bought for EMI plus the processing fees, which is indirectly the interest you pay for the EMI facility, and it loses its value over time. Most cases, the moment you buy it, it is best if you limit your borrowing. So the takeaway is borrow your only when it's absolutely necessary. When borrowing, make sure you understand all the fees associated with it. Sometimes the real cost of borrowing money will be hidden as miscellaneous charges like processing fee, scripts, box, etc.